Estate Entrepreneurs Podcast.
Welcome to the Real Estate Entrepreneurs Podcast. So here I am trying to adjust the camera. I don't know how I kicked it, but I kicked it and now it's loose. Um, Today I have one of my favorite people in the world, my friend Amanda Webster from Florida. I would say Tampa, Florida, but I know you live north of Tampa.
Yes.
I don't want to disclose the exact location just in case. I don't want your husband to tell me, hey, man, you're crazy. You told people where we live. Anyhow, Amanda, how you been?
I am fantastic. Can't complain. How are you?
I'm doing amazing. I'm actually in Venezuela right now in my office. I will be here for maybe the next 10, 15 days. Um, and we've actually had this podcast pending for a little bit. I had invited you back then in your Fund and Grow days.
Yeah.
But here we are. And today we're going to be talking about the top 5 mistakes real estate investors make, which is I'm gonna be laughing at it because I'm pretty sure I made all of them. I'm probably guilty as charged. But anyhow, Amanda, can you tell us a little bit about yourself first? Like, where do you come
Yeah.
from? Do you come from a multi-millionaire family? What's the deal?
No, I did not. Unfortunately, otherwise I probably wouldn't be talking to you today, right?
Yeah.
No, I didn't have a silver spoon. No, I am originally from Florida. I am homegrown here. I do live north of Tampa. Been here my whole life. Love the snow. I love the sunny weather. Can't stand snow. So this is where I'll probably retire and live my whole life. No, but I raised very normal, probably was lower than middle class. Didn't know that back then.
We just didn't know how poor we were until we found out there was better out there.
I know my parents were amazing. They're the exception to the rule in the sense they are still married, going
good.
strong. Definitely had a normal childhood in that sense. But no, so born and raised here. I actually started my career in the legal industry. I started at 18 years old, right out of high school. Was super ambitious. And very quickly climbed into management within the law firm, realm. Did that for 17 years. The last
Wow.
10 years, it was managing law firms in the Tampa Bay market, mostly in family law, divorce law, super exciting stuff. And I got burnt out, which is not surprising given that type of law. And this thing called COVID happened. I don't know if you've heard about it, but it
Right.
happened. And
I caught it probably 5 times.
I was fortunate. I only had I think once or twice.
Yeah.
But no, it happened. The law firm had to shut down for lack of, just people were not able to spend money on, divorces, even though there probably was a spike after COVID. When everyone
Honey,
was
we
home.
better stay married because I don't have half to give you right now, okay?
I mean, seriously. So I was home with the kids for 6 months, being a stay-at-home mom. I have 5 kids. Back then it was only 4, but I have 5 kids now, but 4 kids, stay-at-home mom. My husband is in the military. He was pulled away for testing sites, like he was managing the COVID testing sites, so he wasn't home. It was crazy time. But it was an opportunity for me to figure out. I got 6 months to figure out, what do I want to do, right? I don't want to do legal anymore. What do I want to do? So I actually found a home for almost 5 years with Fund and Grow. It was amazing. It was
Shout out to Fund and Grow and Ari out there.
yeah. Listen, Ari's amazing. He's built an amazing thing over there. Super grateful for the time I had there, and feel like I learned a bunch. I hopefully left a huge impact, and got to a point, where funding did my thing. And I said, you know what, I want to try something new. I want to do something new. I want to keep growing. And so just 2 months ago, made a leap, made a change. And now I'm at a company called Acrruity. And we are accounting, bookkeeping, CPA firm ran by a real estate investor. So it's literally built by investors for investors, type of accounting. And that's what we're going to talk about today, obviously, is the financial mistakes of it. But, I would say, I have a couple college degrees, although I'm now of the opinion that they didn't really get me very far.
Right.
It was all about on-the-job training.
What were your degrees on?
I have a dual bachelor's in business management and human resources.
Okay, so yeah, I mean, maybe you're not acting as a human resources person in a company, but
Yeah.
they do teach you a lot of things, right? So I'm not that kind of guy. Look, I don't have a degree. I
Yeah.
kind of like, I winged it all the way. Fake it till make it until you finally made it, and then. But anyhow, I don't. I believe everything has a place. In
It does.
right. I don't know how many people I met with degrees that are doing something completely different from their degrees today.
Yeah.
Even doctors, like
Yeah.
people that became doctors, and now they're in a complete different business line, right? So, what I believe that the university or colleges and those institutions teach you is to be persistent and resilient enough to go get the degree and then go venture into the world and grow on your own. But so I'm not a university hater. I'm not that type of guy who's like, oh, nobody should go to university. No, like everything has a place. Like
No, I just
if I
feel
go to surgery, Amanda, I really want to make sure that doctor got his
okay.
degree. Okay.
There's exceptions to the rule. That's true. But I would say I wish that we could get to a point where we focus so much more on the training that's
Of
actually
course.
happening on the job, right? Like the biggest thing you come out of college is nobody will give you a job because you don't have experience. They just expect you to have it. So I just, I was very fortunate. I started working for an attorney that was older, like in his career, and he took the time to mentor me. He took the time to like, it wasn't just go do this, go make this motion, go, fill out this petition. It was, let me explain to you why. Let me explain to you like the case law that goes with it, the rules of procedure so it was like a really cool situation that I found myself in. And I hope that, other people can find themselves in situations like that. Cause I stayed in law for 17 years. My degree wasn't law specific. I definitely used parts of my degree for sure. Don't get me wrong. But I think that I probably could have done it a little bit cheaper than I did.
Of course. Yeah. I get it. Like, yeah, I get it. So, um, anyhow, now you're in Acrruity, right?
Yes.
Now, what does Acrruity actually do?
So we are a accounting, CPA, bookkeeping type offer. It's our firm. Casey, who's the one of the co-founders, is a CPA accountant. He has his degree. He actually was a corporate accountant at one of the big fours. And 6 years, almost 7 years ago now, he decided, like a lot of people, that this just wasn't what he wanted to do. He didn't want to sit in an office and do accounting every day. Just wasn't his thing. It wasn't his passion. So he took a very big leap of faith, and he has an amazing story about how he literally left, took out a personal loan to cover his bills, and figured out, I'm going to become a real estate investor. And he, in 5 years, went from zero to 120 million in his portfolio.
Amazing.
And most of it's because I will tell you, like, it's the accounting backside of it, because he analyzes deals very differently as an accountant, because he analyzes all that cash flow very differently. And he was also able to get access to more funding because he understood what the banks would want on the financial side. So he took that knowledge and was able to excel at a completely different thing, still based on numbers.
Good deal. So, based on what you and I actually were talking about before we went live,
Yeah.
can you start with what's the number one mistake?
Financially speaking, the number one mistake that we have seen is, it's going to sound funny, but inefficient chart of accounts. People don't set up their accounting to have a chart of accounts that's aligned with their specific industry, that's aligned with the best practices, that's aligned with understanding and making it consistent. That is, weirdly enough, the number one thing that we see is categorizations are everywhere. I'm sure, I'm not trying to attack you, Ricardo, but I am sure that you swipe your credit card and pay for things and don't ever think about where it belongs in the chart of accounts.
I do when I am my own bookkeeper, okay?
Yep.
And I do regret it when I go into QuickBooks and start classifying things because I'm like, what is this, right?
Yeah. Yep.
So I agree. Now, in the days that I was a real estate investor, because today I'm not doing the investing I was 10 years
Yeah.
ago, okay?
Yeah.
I didn't do that. I had a bookkeeper that ran all of that stuff, and by all means, they kept everything classified like they were supposed to. And I remember one time, one of my bookkeepers, is the one that it was a she. She went and created. She put an address on QuickBooks, and so everything for that property
Yep.
specifically was, every charge was going to a property, right? So we could keep track of expenses and income per property. That way we knew what belonged where, right?
Yeah.
So but this is years ago, right? I don't have a portfolio like that anymore, and our accounting is more basic today. Is money comes in, payroll goes out, here is what's left and done, right? So but you are right. It is a nightmare trying to remember what is this Home Depot charge.
Which
Like,
property was that for? Like, where
that's
does that belong in here? And if you set it up right from the beginning and you have a good SOP type, system set up for whoever's running the books, you keep it going, right? And it's super easy to keep everything flowing. But that's the biggest thing. That's probably one of the areas we do the most cleanup, is that one specific inefficient, area. And so we spend a lot of time on the setup when we take over people's books doing it. And they don't even realize what they're spending. And they don't realize we have found properties that weren't even cash flowing in the positive because they were not paying attention to that.
what's number 2?
All right. Financial statement inaccuracies, right? So getting your financial statements is one thing, but making sure they're actually accurate and having reoccurring errors causes just like a domino effect on that. So how do you trust your numbers if you're not actually able to kind of checks and balance them? And that's one thing that we found huge in our clients, is that they are just trusting the reporting, not realizing it has errors all over it because nobody's actually going in and double checking the work. There's not a proper system in place for that. Again, SOPs are everything in business, right? Having those procedures in places, and it's the same thing with accounting. So it's another huge area that we see our clients not understanding, that they are making business decisions based on financials that aren't accurate.
What is number 3?
Number 3 is something that we don't handle ourselves, but we work in conjunction with other people, which is risky legal entity structuring. So when you don't have your entity structure correct, it causes issues even in your accounting and your financials, and then leads to a whole plethora of issues. So we partner with people that are, really good at that, because that's not our necessary area of genius.
Can I give a shout out?
Do it. I
That
know
is
who it is.
Tony Dixon and JJ Childers with Advanced Tax Group. Those are my favorite
Yeah.
attorneys in the world.
Yeah.
So
We love Tony. And I told you I was talking to him today. I was texting with Tony today. But and it's one of those things where, so we assess it. We go in and look and see, is the structure correct? We give them a roadmap of like what it would need to be for proper accounting financial purposes. But then we say, if you really need help, you got to go to the right people, right? You got to have the right people in place. But that is a very specific thing that people don't pay attention to. So like my question to Tony today, as an example, was, hey, getting ready to buy a property in Florida, don't own any other property in Florida other than my homestead. Where do I set up that LLC? How do I set up that LLC? Like making sure I understand 100% from the beginning so that I know. And so I just go right to Tony and say, give me your expert advice, and that's what we all should do, because when it comes to legal, you shouldn't play.
and you shouldn't let them do it, right? So
Yeah.
hey, let them set it up for you. They know
Yeah.
they know what to put on the operating agreement, they know where to go, how to get it, they know how many members it need. Do you know
Yeah.
do you know that having a certain amount of members is important on an LLC?
There's so many nuances that I don't know, because it's not although I came from legal, I didn't come from that side. So I don't know those things. That's why I always lean on the experts in those areas. But it oddly enough affects your financials and affects your accounting of your business if your entities are not structured and set up correctly. It causes tax implications. It causes all kinds of reasons why you need to have it set up.
That's right.
Yeah.
What's number 4?
Incomplete or unrecorded transactions. This is probably a very notorious thing that people are knowingly doing, is they're not recording certain transactions, which can cause huge critical errors, which can cause tax implications. You don't ever want to get, audited on your taxes and find out that these things weren't recorded, So that is a huge thing that we go in, is things that are missing from the books, even if it's just certain pieces are missing, and like we
Like
know
what?
this
Can we give an
accounting.
example of what could be missing? Like,
Sometimes people will use, this is terrible, they'll use other money outside of that direct business to pay for something. And
yeah,
they don't
you
ever,
borrow from Peter to pay Paul. That's what
right.
it's called.
And there's nothing wrong with having to do that shifting. It's recording those journal entries correctly.
Correctly, as a loan, for
Yeah.
instance.
Yeah. So if you don't do that,
Ask me how I know.
yeah. If you don't do that, there's a lot of things that could happen from it. So, right. So I'm not a tax expert myself, although we do have people on the team that are really good in tax. That's one of the things that we have to watch out for when we do someone's books is, are they actually recording everything correctly and making sure that we have a checks and balance for that, right? Because you want to make sure they're not just entering things, putting in, unreliable numbers that they don't really know. So that leads into so many other pieces that can be giving errors in your financial accounting, is not having those transactions. And how do you know that your properties are cash flowing if you're not recording everything correctly? And you don't want to know once you realize that you're over, you're over it, you're in the negative, and now you got to offload a property or figure out how to do something different, and you're not creating the wealth you wanted to create, right? So getting that up front is super key.
Yeah, I made all the mistakes, Amanda, to be honest with you. I know we still got number 5, but um, when I first set up my entity, I completely set it up incorrectly, number
Yep.
1. And a few years later, that was a big problem.
Yeah.
Because the problem is you don't catch it for a few years.
Yeah.
And you're going and going and going. And then next thing you know, it could be either a tax implication or a legal implication. On my
Yep.
case, it was a legal implication
Yep.
because I got sued. And when you get sued and you have the
You're
wrong,
breaking the veil of things if you're not careful. Yeah.
that is correct.
Yep.
Especially when you commingle money and
Yep.
you borrow Peter to pay Paul, and then you have a whole mess. Then the judge says, "Dude, you're all of these things. You got 10 different LLCs, but they're all the same. They're all you."
Yeah.
And
Yep.
and the way you move the money around, that was a huge mistake. So yes, that's how I found out, right? So
Yep.
why do people don't go to a CPA or an attorney at the beginning? Is because they don't think they need it,
Yep.
because they're not big enough yet,
Yep.
and they don't think that that money is very well invested into setting the business correctly, because they have a friend that's a CPA or an attorney that say, "Oh, just get you an LLC on whatever website and you should be fine."
Yep.
And that's a huge mistake. All right, what is mistake number 5?
So this is my operational brain, but missing key processes and scorecard metrics, right? So not documenting your processes, essentially, not actually paying attention to certain, KPIs and scorecard metrics that can be indicators to know if you need to look at things in your business, right? Part of what I like to do in the business, I hate using the word audit because it's not the word I want to use, but like I go through and double check all my processes for accounting, for operational purposes, for marketing, right? All of those things. And when you don't have a standardized process in doing that and double checking yourself, you're going to not really be able to close your books accordingly, right? So, and if you don't know your numbers, how are you making decisions, right? Like, how do you make decisions if you don't know what you're looking at? So, basically, it's really more down the line of just, there's a lot of real estate investors out there who are just, they're just making the money, right? They're just out there, they're finding the deals, they're getting the things, they're flipping the properties, and they don't have time to think about it. So they're just doing it, right? And they don't understand that they're leaving all these things, and that's about taxes, right? Come to the end of the year, they don't have everything entered correctly. They've got a shoebox of receipts in there with like little handwritten notes on them, and they have nothing done correctly. So having a documented process for all the essential, functions of it, closing, reconciling, reporting, everything, and understanding your scorecard. And your scorecard, everyone's scorecard can be different. I don't think, most of them have some standard things, but what are you actually watching to know how many properties you can buy. Can you buy an additional property this month, or do you need to wait? How do you know that if you're not looking at your numbers?
What are the main things on a scorecard that we need to be aware of?
So it depends on the type of real estate investor
So
you
let's
are,
talk
right?
about single family homes, right?
Single family homes, you need to look at the cash flow, like the net profiting cash flow you have on every individual property. You have to treat every property as its own
Its own
entity.
company, yes.
Even if you don't have them set up as a separate entity, you still need to treat them that way, because you need to be able to look that granularly to see where everything's at on a cash flow net profit margin for you, because that's what's going to help you. Because a lot of people, if you do it the way that I think you should, is you're borrowing equity from other properties, right? That's how you're building that up. And how do you know when you're going to reach, what your loan, LTV is? How are you going to know what your 80%, DCS, oh my God, I never say that
DSCR,
one.
yeah.
DSCR loan, parameters can be for that next property? Or how are you even quantifying if the property you're looking at is actually going to cash flow just from a theoretical when you're looking at that property, right? So I think the scorecard starts from when you're looking at the deal before you even buy it, and seeing everything that goes into that property, all the costs that's going to go into it, and where is your profit margin going to lie with that. And the same thing for general business, right? Looking at top line revenue, bottom line revenue, what's your margin on this case, per property, whether it's a buy and hold or a flip or a host, like what are your margins? And the only way to grow and scale is to increase the margin percentage to be able to keep putting money into that next deal, right? To keep going up and keep growing. And then once you're ready, which I don't know that any real estate investors actually done, is what does that cash flow look like? Do you have enough passive income to live on, right? Because hopefully that's what the goal is that you're going to have that passive income, you've built your portfolio, and you're done. So it's those are the main things that I would want to look at. Same
I
thing, look at marketing. It's
I
the same.
don't know if it's passive,
Well, it probably never is truly passive, I guess.
especially in single family homes.
Yeah.
You're always actively involved in them one way or another, whether
Property
it's,
management's fun.
yeah, the property management side, whether something broke or you're evicting a
Yeah.
tenant.
Yeah.
My wife is going through that right now. She's doing an eviction, and she called me like 2 hours ago, freaking out because I don't know, people at the courthouse didn't care that she was evicting somebody. Who knows, man? But real estate can be a lot of fun, but it can also, um, people buy into the wrong dream. Like I, I remember when I started in 2008, I I will go to these meetups, and back then it's not like it is today, where you go on meetup.com or Eventbrite, and you got ton of options to go and network with investors, right?
Yeah.
Back then it was like there was no connectivity. So like how do you find these people, right? So I started finding groups, and I remember seeing this one guy that he will talk about how he was cash flowing on 100 properties, $250 a month. No, actually $350 a month. So that was $35,000 per month. And he
Yep.
said, "Who can live with $35,000 a month?" And we were all like, "Fuck, all
What?
of us, blah." Like how like I don't know who you are, but if you can't live off 35 grand a month, there's something fundamentally wrong with you, right?
Yeah. Probably should
Um,
do an audit on yourself.
right. And that's when I raised my hand, and that's when I bought that dream. Like that was like, maybe if I get to 100 properties and I'm cash flowing 35,000, I'll be set. I'll be fine. That's a lot more money than what I make in corporate America. And I was paid very well. I was a multiple six-figure kind of guy in the oil and
Yeah.
gas business, and but I was like, man, I'll tell you this, Amanda, I got there and I did not like it. I did not like being a landlord. I didn't
No.
like owning the amount of properties I did at the time. A lot of the properties, they were in paint, like that my tenants were not performing. It was a mess. And I became a motivated seller very fast. I started, and we didn't have the programs we have today.
Yeah.
All these DSCR, no documents, no that they don't care what your credit is. Like back then, you have to have a 700 plus credit and they only had these blanket loans that were like 9% interest only loans, and that's
Yeah.
the only way you could finance all these deals. But there were no 30-year, those 30-year DSCR loans, they started coming around in 2016 and 17. And the only company I knew of that did them was Corvest Financing, by the way. Today, there's thousands of them out
Oh
there.
yeah. Yeah.
And sometimes the money's coming from the same spot, but um, that's when I knew that when we started doing our big refi, our first one was like 20 plus properties. Forgot how much it was, a couple of $1,000,000. Because we focused on houses that were like 100 to 250 grand the most tops.
Right.
Like we didn't go past that for rentals. So we were doing about 20 of them. Well, that's a couple of $1,000,000.
Yeah.
And nobody would be able to finance us on a 30-year note. But that's how we got to Corvest. Then Corvest was like, yeah, we can do you guys. At the time it was like 8% interest for 30-year note, and then they had a prepayment penalty of X amount of points per year for the first 5 years. We couldn't
Wow.
refi. Yeah, and we had to get on those loans because that was about the only thing we could do at the time.
Yeah.
Today it's like, can you breathe? Yes. Does it cash flow? Yeah. Do you have some equity? Yeah. Okay, we can do the 80% DSCR, right? So today is a lot easier to do real estate investing as a landlord, and if you want to accumulate a bunch of properties. But I tell people now that I know what I know,
Yeah.
I'm like, look, getting to 100 properties, that's fancy, but that's not for everybody.
No. I mean, property management is not for
It,
everybody.
it is not for
Period.
everybody. It's like,
Even if you have a company, even if you're, and of course you got to add that into your financials, right? But even if you have a property management company, which is hard to find one that goes over multiple markets, but it's not easy. It can be very stressful. I get it. Listen, I'm starting a little journey myself, but it's gonna be a little journey.
I
It's
tell
gonna be very
people,
small.
I tell people now, I say, look, how about 5 to 10 properties?
Yeah. That's where I'm at with it. Yeah.
Why 5 to 10? Because we all get caught up on the scale. Let's be like what's his name? The owner of oh my god,
Oh, Casey.
Casey. Let's be
Yes.
like Casey, $120 million portfolio, right? So, all right, let's divide. Let's say he has them all in
But they're
single
all in
family.
one market. That's where he did everything in one market.
That's fine. That's perfectly fine. I mean,
And
but
it
let's
makes it
say,
easier.
are they all single family?
No.
He's got some apartments in there and duplex and things.
He's
But
got some commercial buildings.
let's
Yeah.
suppose they're all single family. So let's divide that by 175,000 a pop. All right, that's 685 properties, man. Now, if you do 685 properties times, let's say he cash flows 350, which he probably does better. That's still $240,000 a month on cash flow on those properties. Now, if he's doing more than that, then because especially on the apartments, he can probably do better. Also, the price point on the properties and
Yeah.
everything has to do with it, right? But guess what? Making those 240 grand a month on cash flow, it's a lot of work. And don't think you're keeping those 240 on your pockets, because you're gonna have to pay some people to help you out.
No, he's got a property management company that he owns. He's got, or he's at least an owner in. He's got the construction company that he's got a involvement in, just to service. So it 100% is. But that's how you do it, right? You have to. That's why people build those like whole rings of
Well,
businesses.
it's called being fully integrated, and
Yeah.
and that's the way I was. I was my own contractor. I was my own property manager. I employed over 100 people, right, locally in Houston, just so I could keep up with all these properties and plus all the flips that we used to do.
Yeah.
And then I was thinking, I'm like, why did I get caught up on scaling like that when I could have just done 5 to 10 houses, pay them off? Which, by the way, let's do the math today. 5 to 10 properties today. What's the price point on the property you're buying?
It's 250.
250. Okay.
Yeah.
Now, how can we predict the future? That's a good question. How can we predict the future? Let's see if you know this, Amanda. You should.
I mean, I would go with the data that's available
That's
and
right. You look at the
yeah.
past.
Yeah.
So, in order to predict the future, if we want to predict the next 10 years, okay, which is, by the way, how Robert Kiyosaki teaches.
I'm
If you
aware.
if you read his book,
Yep.
Rich Dad Poor Dad, he talks about 10-year increments, right?
Yep.
So, if we want to go look at the next 10 years, we look at the past 10 years.
Yep.
So it's
Oh,
simple. Look at the same property and find out what the value was 10 years ago
yeah.
compared to today. Now, if the trend continues to be the same, then your $250,000 property in reality in 10 years should be a $500,000 property.
Right.
It's pretty
Yeah.
much going to double in price.
Right.
By the way, in 10 years, you should now, if depending if you do a 30-year loan,
Yeah.
your equity is going to increase by maybe 30 to 40%. Maybe. And the reason I say that is because of the interest rates
Yeah.
and but you're also going to have a depreciation, which
Yep.
you guys understand very well as CPAs, right?
Yep.
So the appreciation and the depreciation plus the increase on value and the pay down on your tenant, that's really what creates that wealth.
Yep.
So when you look at it, you're like, man, I don't need 100 or 200 properties to have a good nest egg. I only need 5 to 10. So let's suppose we do 10 of the $250,000 properties you're talking about. That's $2.5 million
Yeah.
as a whole, right? And let's say it takes you 5 years to do that because you can do two a year. You buy one, fix it all up. Especially, of course, you're gonna buy it off market, distress, discount it. Um, if you're smart enough, you're gonna go use a hard money loan or a private money loan, which you got plenty of connections for that. And you're probably not gonna use any of your money. You're gonna use somebody else's money with some of the credit that you learn how to leverage in your past, opportunity that you had. And then in a matter of 5 years, you're now gonna own 10 properties that are worth maybe 2.5 to $3.5 million, but you're only gonna owe hopefully 1.5 to 2 million, which gives you 500 to a 500,000 to $1 million. But in 10 years, you will have 4 to 5 million bucks in those 10 houses.
I think it's all relative, right? Like what your goals are, what you want to do with it, and we're my this first deal I'm doing, I'm falling into um with my husband. There's some inheritance pieces of it, so we're falling into it nicely, and so I'm like, you know what? Let's try it, and if we like it, then we'll go from there.
Well, you will run into challenges, okay? Because there's you're getting a set of challenges. That's what you're getting. Right? You're solving one challenge at a time. So it's an inherited property. Now you're gonna go figure out how much money to put into it, like fix it all up and or whatever, right? But it's solving one challenge. That's what a real estate investor is. Is a problem solver.
I've
That's
solved thousands of problems, not necessarily these styles. So I'm comfortable, my husband's in the military, career military. He solves problems all the time. So I
all
feel
the
like
time. That's what we
it'll be
do,
good,
right?
and we'll see. But I think that knowing what I know and having the connections I do, knowing the accounting side of it now and understanding, like, making sure I'm setting it up properly from the beginning, even only having one property. Not saying I have to like go hire a bookkeeper for that, but I at least can get it set up from day
Now this is
one.
what I would do though, and
Yeah.
I'm gonna throw a wrench on your equation. I will put it on a land trust, not on an LLC.
Yeah.
Now, what you do is, and this is not legal advice for anybody, but what you do is you make the LLC the trustee of the land trust and possibly the beneficiary. You can. I'm not gonna tell you who should be the beneficiary. I can do that offline. But that's how you create multiple layers of asset protection under um, under that trust and the LLC, right? So that is something I didn't know. when I started, and I started buying properties and putting them on LLCs, and I was just creating an LLC for each property, right? Well, it got to the point to where I was tired of it. I was like, man, every time I do an LLC is like $700. And you know what? We didn't know how to like put an LLC on, or like we had a QuickBooks account per LLC basically, and those fees started racking up every month. So before we knew it, we were paying like 2 to 3 grand a month on QuickBooks when we could have had all these multiple properties pour into one main account and then just paying one subscription. But then we had to renew every LLC every year. So dealing with the Secretary of the State, and some states are easier than others. I love Florida, by the way. It's so easy
Yeah.
to
Yeah.
set up and renew. It's unreal. So I literally shut down most of my LLCs in Texas, and I operate out of Florida now for that reason.
Yeah.
Because
Yeah.
it's easier to deal with the Secretary of State. But in Texas, it's like you have to ask Trump first and then the Pope if you can actually pay the renewal fee. You know what I mean? Like, wow, you need like you got to become a NASA scientist to deal with them, the SOS, and it's like
There's more than one of those. There's several states that are a pain in the butt to
wow.
deal with on the Secretary of State side. But then there's plenty. Yeah, I mean, I'm partial to Florida because I'm here. But yeah, I've never had an issue setting up even just a basic LLC
Easy.
for any purpose, right? And yeah, you're right. I haven't figured out what I'm doing yet for it. I'm obviously in conversations with Tony for that exact reason, right? Like
Yeah, he will guide you the right way.
Yeah.
Also, make sure he's a multi-member. He will probably suggest that.
Yeah.
Don't do a single member for multiple reasons. But like I said, guys, we're not giving either tax advice or legal advice on this call. We're just having a conversation on how things happen. And that's how you get in troubles, Amanda.
Yeah.
By not asking the right people the right questions, and by not paying for that service.
It's the golden, rule of, if you got arrested, are you going to go represent yourself in court? For the most part, no, right? There's some exceptions to that rule, but you shouldn't, I should say. You shouldn't. And when you do, you tend to have a more of a punishment or more of a fine or whatever it is. But when you have an expert, when you have somebody who knows what they're doing, it can save you thousands, tens of thousands of dollars, depending on the level. So I think that's kind of the reason that, and that's why we are in the circles we're in, to make sure we have all the best people at our fingertips to be able to ask those questions. And that's one of the things that, that I love about this company and about Acrruity is, being able to truly offload that. You focus on doing deals, you focus on doing that. We're going to make sure everything's clean, and we're going to close your books every month, and we're going to give you these financial reports. And now you can really see how each of those properties are cash flowing, what's your overall, profit margin for a company, and how can you grow, or do you even want to grow, or where should you invest? Then it's when you get to a certain point, do you need a tax strategist to see how you can offset these high tax bills legally by doing something else, right? And knowing when that point is, and having those pieces of advice in your corner. And being able to get more funding, right? Being able to open your doors to more funding, because if you want traditional funding, you're going to have clean financials in your business. Like, it doesn't matter what kind of business it is, whether it's a real estate investor, whether it's a restaurant, it doesn't matter. If you don't have clean financials, you're not getting funding, not traditional funding. And even some of the alternative funding still need to see those, those three main financial statements, which is your cash flow statement, your balance sheet, and your P&L. You need all three when you're looking at those. And if you're not closing your books to get them, it's almost impossible.
I love it. Amanda, how can people get a hold of you?
Well, it's going to be super, super easy. If you want to get a hold of me, just find me on social media. I'm always on. I'm on every day. But if you want to learn more about Acrruity, we offer a free call just to see if it's the right fit for you. Acrruity.com, ACCRUITY, Acrruity.com is the website. Like I said, you can book a call on there. It's free. You can learn some things. You can go in and see testimonials, whatever. But it really is an amazing thing to have someone who understands real estate investor, accounting, because it's very different than a restaurant. Although we do service any service-based business, we can handle any. We have other things. We have hard money lenders that are our clients. We have social media people that are growing through that as our clients. We actually do have some restaurant owners, because that has a mix of real estate mixed in with it. So we have brokers, that have agency offices. So it's not just that, but that's our specialty, is real estate investors. And it can be any of them: flippers, wholesalers, buy and holds. It doesn't matter.
Good deal. All right, guys, Acrruity.com. Go reach out to Amanda. She's also on social media, Instagram, Facebook. Put Amanda Webster and she'll be there. Tell her I sent you. With that being said, don't forget to hit share, like, and subscribe. Amanda, thank you so much for being here today.
Yeah.
Tampa, Florida, we have a 10 growth coming up for the first time. It's going to be in June 27th, 28th. Hopefully you'll get to see Amanda there. We don't know that yet, but with that being said, guys, you all have a great day. Bye, Amanda. Thank you.